What's up, family? It was a pretty tough close to last week, and it's been a pretty tough couple of weeks overall since the whole news about the interest rates going up. And there have also been a lot of concerns for investors over new efforts by financial authorities to regulate the operations of the country's largest tech firms, leading to big sell-offs of stocks like Kakao and Naver. Still, in times like this, it's good to zoom out a little bit and get a better idea of the whole investing environment, and that's what we're going to do today with a little conversation about potentially misunderstood but generally overlooked asset classes. Specifically, we're talking about the REITs. You're watching Sekidar, and this is the case for REITs in an inflationary environment. Now, before we continue, we'd just like to remind you that this channel is meant for general education purposes only and isn't meant to replace the legal or financial advice from a paid professional. When it comes to investments, it's always healthy to take a fair bit of skepticism to anything that you hear, regardless of the source. And anytime you hear somebody talk about a stock specifically, whether us or otherwise, it should be standard practice to assume that they have some position on that stock. Now, full disclosure, for this episode, which is on REITs, I want you to know that I hold positions in both Lotte REIT and D&D Platform REIT, so I have a vested interest in those two particular REITs doing well, so you should keep that in mind as we go through this episode. Overall though, nothing we say here should be taken as a basis for investment, and you'll have to do your own research and thinking to decide whether or not you want to take a position in any of the stocks mentioned here. Want to know how? Well, if you scroll down a tiny bit and hit the like and subscribe buttons, we'll do our best to help you figure out how to figure out this game for yourself. That being said, let's get to it. Alright, so we've talked about REITs in a past video, which you can check out in the top right hand corner of the screen right now. In that video, we talk about a few of the popular REITs on the Korean market and the things they do. That video was released at a time similar to this, in which volatility in the market stirred concerns about an impending market crash. Now, however, we have the addition of inflation concerns and the rising interest rates led by Korea's financial authorities, increasing concerns about the country's debt situation. Now, we're going to break this down to a few parts. 1. What are REITs and how do they work? 2. How did they behave in an inflationary environment? And 3. What are some new REITs that we haven't mentioned before? So let's get to 1. What are REITs, and more importantly, how do they work? So the acronym REIT stands for Real Estate Investment Trust, and it refers to companies that primarily own and finance rental properties across many different sectors. When an investor buys shares to a REIT, they gain exposure to the real estate market, profiting from the rental payments made to those companies by their tenants. This often results in a very high dividend, especially since companies themselves are by design required to give back 90% or more of their rental income to their investors. For example, REITs, a REIT that invests in both residential and non-residential properties, most recently yielded 5.15% to investors. Lotte REIT has recently yielded a payout of 5.21%. NH Prime REIT 5.07, Aegis Prime Plus REIT, Aegis Value Plus REIT a little lower at 3.79. But, generally you get the picture. They pay a pretty good dividend. Investing in a REIT is like investing in real estate without the hassle of really having to do any of the heavy lifting. Note, dividend payout ratios will usually read greater than 100% since the payouts are compared against net income. To more accurately understand their payouts, it's probably best to compare their total payouts to their FFO or their funds from operations to know how much they're actually paying out based on how much money is coming in. But anyways, for those of you who've learned about the pros and cons of dividends, you may be wondering exactly how these companies make money when they're essentially giving all of their rental profits away. Well, this is a little more complex, but in one aspect, it really just comes down to appreciation. It's the same with housing investors. You buy the property and watch its value increase over time. Cool. Now, how do they get the money in the short term to expand their operations? Well, that's one thing worth noting for new REIT investors. Since appreciation takes time and requires property sales to cash in, a key way that REITs expand is through the issuance of new stock. Now, while this does raise money, it means that existing stockholders are inevitably going to get diluted over time. During these offerings, though, you will have an opportunity to subscribe and maintain your existing ownership percentage, but if you don't, then you'll definitely be diluted over time. Now, that brings us up to the next question. Why would they be a good hedge against inflation in that case? Well, let's quickly remember what inflation is at its core. If we shed the general mechanism of the thing, inflation really just refers to the rising of prices. Investing is, at its core, an attempt to protect one's own capital from inflation. In past inflationary environments, investors have turned to gold and precious metals as a place to store wealth, since there is a finite amount of gold in the world and thus cannot be inherently inflated. Unfortunately, however, gold does not in and of itself perpetuate its own value, and this is the first case for REITs. In inflationary environments, REITs will often gain value since rising prices usually apply to most markets, including commodities, consumer products, and real estate. As all prices rise, so do maintenance and labor costs, and by extension, rent costs for tenants, meaning more money for the REITs. This is before even considering the way that companies themselves benefit from inflation, as inflation reduces the functional value of their existing debts. This is because the debts that they usually take are long-term and fixed, and as inflation reduces the value of currency over time, it logically reduces the value of debts denominated in those currencies. Right? Like if I borrow 100 bones from you this year and then inflation goes up 10% and I give you back the 100 bones next year, then I got 10% more value out of that 100 bones than you're going to get at the time that you get it back. Now anyways, while inflationary environments can be neutral for commodities, bad for companies, and absolutely nightmarish for straight cash holdings, REITs have a bit of a competitive edge due to the factors mentioned above, and that's before even considering the benefit that we already mentioned, dividends. Thus, while a REIT investor can enjoy watching the financial health of a REIT company survive and often improve in times of inflation, they can also rely on the consistent cash flow generated by their holdings as tenants continue to pay rent. Is this to say that REITs are inherently ironclad against inflation and that all REITs will thrive during times of inflation? No, not at all. As with anything, there are always more factors to consider like management, the price you pay, the quality of their assets, etc. Still, in virtually all inflationary climates, it's beneficial to at least consider diversifying into REITs for the reasons listed above. And with that said, let's talk specifics with question 3. What are some new REITs that we haven't mentioned before? Well, in the past we've touched on NH Prime REIT, who specialize in Seoul-based office buildings, Lotte REIT, who own and operate a number of Lotte properties, including Lotte Marts, department stores, and outlet malls, and who recently expanded outside of the consumer retail spaces with their purchase of Lotte Mall Gimpo Logistics Center. We also talked about Modutor REIT, who owns and operates a number of hotels and a couple of retail spaces. Today, we want to touch on a different REIT sector that has been popping up since we made that video at the end of last November, logistics center REITs. In short, these REITs refer to companies that primarily invest in warehouses and buildings that receive, store, organize, and ship goods to customers who have, over the course of the pandemic, drastically increased their online shopping. Since our last video on the topic, 2 of the 3 big REIT IPOs to our market have been logistics REITs, so let's talk about them right now. The first REIT premiered on the market a week after our initial video, and it's called ESR Kendall Square REIT. This REIT is very new, with an inception date of February 2020, and its portfolio is composed entirely of logistics holdings with logistics centers located around Gyeonggi Province, as well as down in Kimhae. These facilities house a number of operations for companies like Fila, Sunjin, GS Retail, and Coupang. You can see detailed descriptions of all of their holdings on their YouTube page, which I'll link to right now, and also include in the description box below. Now, since its debuted on the market almost a year ago, the stock has jumped up about 30%, hitting a high up 50% since the IPO date in mid-June at a price of 77.90 per share, before settling with the rest of the market down at 6,650 at the end of the first week of November. Looking at total ownership, as declared by their second quarter business report released at the end of August, we see that the largest ownership stakes belong to a number of entities, including a private limited holding company of the same name. It also includes 2 incorporated companies sharing the same name, ESR Kendall Square and Kendall Square REITs, which amounts to about 10% of the company. Then we have a massive holding by CPP Investments, which is a global REIT based in my hometown of Toronto, Canada, with just short of 25%. And finally, you have institutions, banks, and the little guys like us making up the bulk of the ownership of this company. CPP Investments having such a big holding is a good sign because that means that we can expect comprehensive financial reports in English, and of course we do have them. Now, as an extremely new company, not just to the market, but just it to existence, we don't have much history on the company at all. And that makes it really impossible at this point to determine any substantial trend in their earnings, expenditures, and general management in terms of the long term. Still, we can look at the reports and deduce a few things, and as far as REITs are concerned, I'm assuming that dividends are an important consideration. Now, looking at page 26 of their report, we see this value, which reports a dividend of about 134 won per share for a return of over 13% of their par value. We don't bother ourselves too much with this value, however, since we're paying market prices per share, and on May 31st of this year, the share price was at 66.10 per share, and that amounts to a yield of roughly 2.03%. That was obviously their first dividend since their debut on the market, and we don't know whether or not we'll be seeing more than one payout per year, but given the importance of such payouts and the relative range between 4 to 5% yield for other REITs in Korea, it makes sense to expect that to increase over time, whether that be through an additional payment this year or just larger payments in the future. Now, the second REIT that we want to talk about is even newer to the market and debuted at the beginning of September, end of August, with a subscription of over 36 times offering. If you've been following recent market IPOs, then you'll know what we're talking about, and that is DND Platform REITs. Now, DND Platform REIT is actually a multi-sector REIT, and it is the product of SK DND's investment firm, boasting 3 key holdings in their portfolio. The first, Munle, is a building in Yeongdeungpo that hosts offices for SK Telecom, Samsung Fire and Marine Insurance, and Citibank Korea. The other 2 are logistics centers and are worth another look as well. Their first logistics center was developed with a data-backed startup called Fastol, which is a company that primarily aims to use big data to facilitate high-speed and high-accuracy fulfillment, and that includes AI-assisted same-day delivery and boasts a delivery accuracy rate of 99.99%. The building has been in operation for only 4 months, and Fastol has a full 10-year lease on the building, which suggests consistent profitability of the asset as long as the company can continue to meet their payments. Finally, we have their Global Fulfillment Center, which is an 8-year-old building located in Odawara Prefecture to the southeast of Tokyo. Actually, I think it's southwest. Yeah, southwest of Tokyo. The lease on that building has a little over 12 years left on it, and their tenant is Amazon Japan. This is also some solid news, since that likely means that there will be reliable payments for over the next 10 years as the operation continues to grow as well. Now, we really can't talk about numbers since the company has only been on the market for, 14 trading days, and they have yet to release any comprehensive earnings outside of the due diligence that they had to submit for their IPO a few months ago. Still, it may be worthwhile to keep track of, as logistics REITs continue to debut in a country where online shopping and fulfillment has become the norm for almost everybody and their grandma. I just want to add that SK REIT IPO'd on Monday of this week. That is the 3rd one that is IPO'd since we made that last video. They have multiple holdings in multiple sectors, including over 100 gas stations belonging to SK Energy. I'm not entirely sure, but I think they've already jumped over 10% since IPO. Alright, that wraps it up for today. This was a long one, but given the way that the markets have been behaving over the past few trading days, it felt like providing some comprehensive information. RE alternative investment vehicles would benefit those who are really seeing losses or stagnancy of this nature for the first time. Now, given that REITs and REIT companies are so different from standard companies and specialize in real estate, there's a whole lot more to learn about them, so do your own research before deciding whether or not a REIT is right for you. But if you want to dip your toes in, these options and the ones that we mentioned in our other video are a good place to start. In any case, enjoy the rest of your week and we'll catch you soon. Peace.